Hello, everybody, and welcome to our first webinar of the year, Why Markets Crash. This is a great day to cover a topic like this because with the Dow being down 222 points, I'm sure it's very top of mind for almost everybody. Paul, are you there?
Yes, I am.
Okay, today Paul is going to be our moderator, Paul Schwinghamer, and straight from Los Angeles, California. The disclaimer first, so please take a second to read through this. I do have to show you this. And also on that note, I just wanted to mention that Purple Chips is an information website, and if you choose to invest based on the information on the website, you should seek professional advice before doing anything. So keep that in mind. You are making your own decisions. And secondly, our mission at Purple Chips is to provide investors with research that allows them to identify the best publicly traded companies when they're at attractive valuations. So with me today, Paul Schwinghamer is our moderator, so he's going to be taking questions. If you have questions, please type them into the chat box, and then Paul will read them off to me and let me know what I should be responding to. Now, our agenda today is the two of us will be talking, and I'm going to review the previous crashes based on my experience. I've been in the business since 1984, and I've obviously been an active investor from even before that. And so I'm going to be talking about the 1987 crash, the 2001 crash, and the 2008 crashes. And we're going to look at the key factors that cause a crash and why I think that today it's a little different, and there's some reasons for that. So we're going to look at the catalysts, the valuations, the alternatives, because I know some of you have probably heard me mention the TINA concept. There is no alternative to the market, and that's because interest rates are so low. So we're going to compare what were interest rates at the time when these particular events happened in the past. And of course, I'm going to conclude by talking about, actually, you're going to learn the difference between a crash and a correction, and you'll get my thoughts on why I think this probably is not a crash. And then we'll go into question and answer. So let's talk about 1987. So the facts were that the PE of the 87 market, okay, this was going into just prior to the big collapse. We were looking at a market that was valued at 22 times earnings. Okay, the market dropped about 22%. And this is really important. The 30-year bond rate went from 10.25% down to 7.3%. So the reason I think this is so important to mention is that when you have an alternative, okay, when there's something else where you can put your money, it makes a huge difference, okay, something of interest, okay, and getting 10.25% on 30-year bonds is a pretty sizable, and that's a pretty sizable yield and a pretty attractive yield. So it was pretty easy for investors at the time to switch out of stocks and say, hey, I'm happy with 10%, I'll take it. Okay, now the catalyst, what was happening, okay, back in 1987 was that the Dow had been up 44% for the year. So it was a pretty strong market. And in a second, I'm going to show you some charts on that. Wednesday, October the 14th, okay, all of a sudden the Dow drops, 3.5%, which was a lot back then. And then on the Thursday, there's an announcement, big news item, news flash, Iran hits a U.S. supertanker, okay, with one of their missiles. And then the next day, they do it again. So this is like total pandemonium, and people think we're on the verge of another world war. And then by Friday, the Dow was down to 2246, and then on Monday, after the weekend, the Dow actually dropped 508 points. And that was pretty much the climax of the move. And over here, you can actually see the PE ratio of the events leading up to the crash in 1987. And you can see that I'm not even going to bother. Actually, I'll just show you with the little pen here. So this was at the peak of the market, okay, and this is when the market had gone up 44%. So you can see the evolution, okay, from 1984 up to the 1987 crash. You had a 44% gain, and the PEs kept on climbing from 10 times all the way up to 22 times. Now this sets up the market for disappointment, okay? When you have a very high multiple, Okay, the two things that are really important: high multiple in the market, and secondly, another place, an alternative for parking your funds. So it wasn't a difficult decision for most investors at that time to say, get me out of the market. I don't want to be here because there's risk and I can get 10% in long-term bonds. And what happened, and I remember this very clearly because I actually made a lot of money on that day. I was working for Levesque Beaubien, which actually was acquired by National Bank after. And I think I was the only guy smiling in the institutional trading room because I had made quite a bit of money that day, and I was very long bonds. And it wasn't, a moment of brilliance or anything. It was actually mostly accidental. And I happened to be very long bonds for myself and for clients. And those bonds, because the yields went from 10% down to 7%, those bonds appreciated very, very sharply. It was probably the biggest day for bonds in history. And so I was just ecstatic. And meanwhile, most of my colleagues were just long-faced and not feeling very good. So you can see how these things evolved, and let's just go to the next chart here, and you can see the progression on the Dow. Actually, this is the S&P, and what happened with the in 1987. Now, normally I would show you the Thomson Reuters charts that are live that I have, but we don't have enough history going back there. So because this happened more than 20 years ago, it's hard to get the actual pictures. So I grabbed this off of the web, and you can see the progression. And believe me, when it happened, it was a very big deal. There were a lot of people. I mean, I remember the security guys in the lobby on the Tuesday because some people had been threatening to come in and do a number or go postal on people. So it was pretty scary at the time, and a lot of people were wondering what was going to happen. So that's the crash in 1987. So the key takeaways with this are that a crash happens, number one, when you've got high valuations, and number two, when there's an alternative, okay? And you need a catalyst. And there's a very another important factor too, which is uncertainty. Okay, when you don't know what can happen, okay, when you can't quantify the problem, it sets the market up for a crash. So you've got to have those three things. You've got to have high valuations, you've got to have alternatives, and you've got to have some sort of event that is not quantifiable. And you'll see that what happened particularly in 1987, this was the case. And again in 2008, and I'll get to that in a second.
John, just a quick question. This is Paul. What would have been a normal valuation, in your opinion, for 1987?
Well, in 1987, because the interest rates were at 10%, I think a more reasonable valuation for the market would have been somewhere lower than 15, because it was easy to think of alternatives. Keep that in mind. Put it in the context of today, where we've got a market that trades around 16 times earnings, but really, when you think about it, the interest rates are, they're next to nothing. You're looking at 1 or 2% in the best case. Actually, it's lower than 1% in most cases, and so you really don't have a comparable, and that's why when the interest rates are very, very low, the multiple can be a little higher. When the interest rates are very high, you would expect a lower multiple because stocks have to compete with this other instrument.
Were people, John, do you remember back in 87, were people talking about a crash at that time? I mean, did this just kind of blindside everyone, or was there a lot of talk?
Nobody was talking about it. Okay, people were excited, and they said, wow, this is fantastic. Stocks are doing well. People were actually borrowing money, and they were putting more money into the market. It was easy to get accounts back then, easy. And everybody thought, this is fantastic. The historical, returns on the market are X. And there's no reason why this shouldn't continue. And don't forget that we came off of a period back in the 70s and early 80s where there was almost no growth. The market had been flat. So all of a sudden the Dow's going up and things are looking rosy. The economy's doing well. And then in 1987, there's this giant reset.
So you were long on bonds at that point? I mean, did you have a feeling that something was off just looking at valuations?
It was. I was only at that point. I had only been in the financial business as a professional for about 3 years, or 3.5 years, and it was a complete surprise to me. I did not expect this. I mean, when you have 3 years of experience, you're like total rookie. And I was just lucky. I happened to be in the right place at the right time. And oddly enough, it's something that I've actually found that my own genetic makeup lends itself better to situations like that. So I tend to do very well in markets that are correcting because I can see these things coming, and I've had a little bit of experience with that, so I'm fortunate in that way. Let's talk about the dot-com bubble now in 2001, because this is another situation where I don't know if I would call it really a crash, but it was a crash in a particular sector. Okay, and this is where there was just pure nonsense happening. We had PE multiples at the time for some stocks. They were well over 100 times earnings. And, it's pretty hard to justify owning a company when, if it's trading at 100 times earnings, that's just a ridiculous multiple. And if you put that in the context of a person buying a business, if the business only earns $1 and you're paying $100 for it, it takes you 100 years just to get paid back. And that's nuts when you think about that. And a lot of people don't realize that when they're buying stocks. It's the income stream that the company will generate discounted back to today. So it's the present value of the future income stream. So what happened with the dot-com bubble was interesting because you had all these tech companies, and I remember very clearly what was happening at the time. Okay, people were talking about the new economy, and they really said, this time it's different. And they said because the internet was in its infancy and that everybody was going to be on the web, and they didn't even call it the web back then. It was, and by the way, when they spoke about a website, it was www, and they often said http:/whatever, and it was pretty nuts. Anyhow, they all said it was different, and I remember a lot of companies that were going public had disclaimers saying there is no foreseeable revenue model on this, and they may not make ever any profit. And people were going for it because they were the first movers. There was this idea that you had to go big or go home, and it was just insane. And I remember analysts who used to be value guys saying, oh, it's different now, new economy, and things are just going to take off. So what happened? Let's look at the facts. The PEs were super high on the stocks. Okay, so the valuation, that's the number one thing you look at. Valuation was crazy. It was irrational. The market dropped about 60%, okay, and I'll show you in a second what the chart looked like. 30-year bonds were paying 6%, okay? Now, maybe it's not a fair comparison because we're talking really about the tech sector. And what happened, by the way, value stocks, okay, I remember the banks and things like that, while all these tech stocks were going up, what was happening was people were selling all their value stocks. They said Warren Buffett is a loser. At that time, everybody wanted to get away from the Berkshire Hathaways of the world and solid companies like the Boeings and whatever, and they were going into the Broadvisions. As a matter of fact, I remember that Broadvision. I remember the day that Broadvision, this one of these big internet superstars, and by the way, this was a company that was working on personalization of websites, and all of a sudden their market cap was $27 billion, and it was superior to Boeing. And I just thought, holy cow, this company that had just a few hundred employees and no revenues to speak of was bigger than Boeing, which was like an established world leader in aerospace with real hard goods. And it was just incredible to think that. But people said, hey, it's different. Well, as history taught us, it wasn't different. So the valuations were ridiculous. There was a place to put your money, and there were some great value stocks around that were nice and cheap. So people switched out of it. Now, what it looked like, the dot-com bubble was pretty amazing because the NASDAQ is the best reference for the dot-com bubble. And you see the NASDAQ index actually went up from about 1,000 in, let's say, the mid-90s up to 5,000. And so then, when the market started correcting, I'm just going to grab this. So you can see the peak of the market was right here, around 5,000. I remember the day that happened. And then, of course, there's this correction, and people are thinking, oh, well, let's just buy here because it was so good before. So then the market goes up, and then kapow. Then the reality sets in that, hey, maybe what we're doing is crazy. So that's what happened with the tech bubble. And it all boils down to, all this nonsense about, like, the valuations were too high. There was a comparable or something that you could invest in. I mean, there were value stocks and there were interest rates that were reasonable at the time. You could put your money into 6%, which, by the way, wasn't that flattering at the time. I mean, people that were doing tech stocks were making lots of money, and then they lost lots of money. So let's go on to the next chart here. Just a minute.
John, is there any other technology that's like this right now, like emerging tech or something brand new that?
There have been many examples of particular sectors, and I can name a few. In very recent history, there was the solar companies that were very, very hot for a while. And you know what? I'm going to bring something up here. I'm just going to switch over to my screen of a company that was the top company in the solar field. Here's First Solar. Okay, let's look at the monthly progression. So this is what happened during the solar boom. Okay, a stock like First Solar went from $20 up to about $250. That was a real a bubble that happened in solar stocks, and all the solar stocks did the same thing. And then, of course, there was a massive correction, and they went sideways, and now they're drifting into more real valuation. Now, the other stocks that did something like that very recently were the 3D stocks. This is what happened recently in the 3D stocks. This is pretty amazing because the 3D stocks went from, for example, this company called 3D Systems, which is one of the leaders in that field, went from $10 up to $90, and of course straight down. And today it's worth about $7. So that's what happened in those particular sectors. Now let's go back to the subject at hand. Let's talk about the 2008 credit crisis, and this was a real collapse. Okay, first of all, let's start with valuation. The valuation of companies or the indices was about 25 times. That's pretty high. Okay, the market dropped about 54% from the top to the bottom. And 30-year bonds were yielding around 5% or 4.8%. These are U.S. bonds, okay, and they actually went to about 3.6% by the time we finished this correction. I think a lot of people know the catalyst. It was the housing bubble. Brokers and dealers were packaging mortgages. They were doing these credit derivatives. And basically, the American public, which was, I would say, the catalyst for this whole thing, had this idea that they could go and buy a house even though they had no down payment, they had no income, and no job. So imagine that. Your gardener was buying this $1 million house, and he didn't have any money. You know, the guy was making $200 a week. They were giving him mortgages for huge amounts of money because it didn't matter, because they figured that the housing market would keep appreciating. So what happened was you had all these mortgage products that were being, you know, one bank would package them and sell them to another bank. Eventually, there was a domino effect. And there was a real concern that these credit derivatives would cause a total collapse in the global banking system. This didn't happen, thankfully, because the governments, they found a way out of this. They had to bail out the banks, of course, and they had the quantitative easing packages, and there was massive stimulus that had to happen to fix things up. And we're still not out of that mess. That kind of sets the tone for what happened back then. This is the chart, the Thompson 1 chart the things that I look at, and what I did was I went back to that period in time for the credit crisis, and you can see how this evolved. And some of you are probably going to say, well, there's some parallels here with what's happening today. And so you know, back at the peak of the market, okay, over here, this was about October 2007. So the market's going sideways, and then all of a sudden, just out of the blue, we start getting lower lows, okay, lower highs, and then by this point here, people are really starting to panic, and then of course you got this big waterfall drop, boom, you know. And then I remember at the point over here, okay, there were a number of companies, and some of the Canadian banks, for example, were like dirt cheap. You could buy the Royal Bank for about $25, okay? They were still making money. The National Bank was like $22. They were still making money, and yet the stocks, the share prices had come way, way down. The valuations were ridiculous. They were so cheap, it didn't make any sense. But the thing is, okay, the problem, the reason that we had a real collapse here, a crash in the market, was because the valuations were high. You were trading at 25 times, 21 to 25 times, and you could take your money out of the market and put it into long bonds, okay, and you were getting about 5% in the U.S. So there was still an alternative, okay. Now, because of the uncertainty of the event that was happening, I mean, a possible global banking collapse, nobody could quantify that, and that's the reason why this was a real crash. Today, I would argue that it's not the same thing. What we have today, we're going to go to the Dow Jones and look at the picture right now. So this is the picture. Let's get rid of this. I get my little pen here. Okay. We had a top in the market here. We've got a top here. We made a low. And it looks like we're about to make another low. Now, what happens with a market correction or even a crash is that they move much, much faster than what people expect. So you see how over time you've got this very gradual rise, okay, and I'm just drawing a channel up there. What happens with a correction or a crash is that you do this sort of thing. You go like this, okay, much faster, okay? So it is not impossible that we could, I think it's actually likely that we're going to get somewhere down here, somewhere in this zone here, okay? But I do not think this is a crash. I think this is a correction, and it's a long overdue correction that we have in the market. Let's look at the monthly chart of the Dow Jones here, and it's perfectly reasonable to think that we might get to some zone, like let's say around 14,000 on the Dow. That's just a mild correction, and you know, to go down from 18,000 down to 14,000 to lose 4,000 points, it's like a 20% correction. A lot of people would say that this is the beginning of a bear market, but the reason I don't think it's a bear market is because, first of all, we know what the problems are. China slowed down, the US dollar is very strong, but there's another thing too, and oil's been dropping. The other thing though is that you can't put your money in bonds. You're not going to make enough money. So the risk-free investments are just not attractive enough. So I would argue that there's no way that we can have a crash in this market. We don't have the uncertainty because we know exactly what the problems are. It looks to me like this is more of a correction, and I think we might have a sideways market. And it's going to present some very good opportunities for us. So if we have a situation where the market goes down 20% and then perhaps later in the year goes back to flat or even slightly on the plus side, that's a broad enough range that we can make money with. So this excites me, and I don't look at this as something that should be avoided entirely. We will scale into it and we will buy the dips. And we're looking at those value stocks right now. I've been very slow to be buying lately, but I can tell you that there's a lot of good-looking stocks out there, and it's going to get very interesting. And we look forward to working with you. So thank you very much, and that closes this webinar. Thanks a lot, and we'll talk to you soon.